Hey everyone. Many aspire to be is a homeowner or one that even owns multiple homes to get some extra cash flow. You may not know just where to start, or you may just need a little pep in your step to get the process going. Well, a few weeks ago, we had Mr. Moses Henry on to give us some great tips on wealth building, and I wanted him back to give us some nuggets on buying a home. So welcome back.
Thank you. I'm getting to be a regular. I like
You
that.
I like this. So thank you so much for coming back.
You're quite welcome. I enjoy it.
Yay. So we'll skip the little intro of who you are and what inspires you and all, since you answered that last time. And we'll
Yes.
just go ahead and jump right into it. So
Okay.
the first thing I had for you is, why is investing in a home important? And when it comes to choosing between a townhome or a house, what factors should people consider?
Okay. Well, the first part is why should people invest in a home? Is that correct?
Yes.
Well, I think that's the first step of building wealth. I think the sooner you get into the real estate game, the better. And the truth be told, if you're paying rent, you're paying someone else's mortgage. It's just not your own. You're paying a mortgage. So it might as well be your own, where you could have the tax advantages, the tax benefits from having a home. When it comes to the type of property to select, and you mentioned a townhouse versus a single family home. And then you also have condos, because I'm starting to see that quite a bit as well.
Okay.
It really depends on your lifestyle. I mean, I don't think you could go wrong in either direction. It just really depends on where you are. Of course, if you're in a single family home, of course, you're going to experience and have more maintenance.
Yes.
You're going to, if something happens to your AC, you will have to replace it. Something happens to a roof, you have to replace it. Now, there are certain warranties and things that you can get to help out with those kind of unexpected costs. However, like I said, it's a matter of lifestyle. If you're not like, for example, now I kind of have more yard than I'm really wanting to cut, so I have to pay someone to cut it. Well, if you're in a townhouse or condo, chances are you're paying either a homeowners association or a condo fee, and they handle all of those things, like the areas that have to be commonly maintained, which usually includes the lawn and the yard and the pool and etc. Okay.
Gotcha.
So the thing is, with townhouses and condos, you will have some amenities that you may not have in a regular single family house and in a neighborhood. You may have a clubhouse, you may have a pool, you may have tennis courts, I've seen it all. And I've also seen some pretty outrageous monthly fees that go along with having those amenities, such as, I think the highest one I've done was like almost like $1,000 a month. So yeah, they can get up there. It's all relative.
And the area, right?
And the area, location. Yep, and the price point. But there are some affordable condos and townhouses that you can get in. And you may, I'm thinking typically I'm seeing condo fees averaging probably 200 to 300 on the average first time home. And some association fees for townhouses anywhere from $100 to maybe $300, $200, $300 a month.
Gotcha.
Just depends on what they're offering.
And yeah, and that makes perfect sense. I think that's the biggest thing, is some people think, oh, you know what? I'm not ever going to use this, so why do I need to pay it?
Right. But they forget, you actually, when you're like on my day off, I was getting off and I was coming home and I was cutting grass, and, it just really depends on your lifestyle. And like with me, I have allergies, so cutting grass is not really my thing. And so I did, but before COVID, I'd have to mask up just to go out and cut the yard. Just to keep the pollen from killing me.
That part, exactly.
Right.
And I think, for us that are in apartments at the moment, we're thinking, oh my goodness, I can just go ahead and put in my ticket for them to fix it.
Right.
Then you're buying a home and you're like, oh shoot, I have to be the one to figure this out.
Well, here again, it's not a matter of if something is going to go wrong with your house, it's a matter of when. And so, on a personal level, I have a home warranty, and I pay like $40 a month. So if anything goes wrong, like now, my air conditioning is starting to make a little strange noise, so I had to call them up, and they'll come out for $100 and they'll fix it. And if they can't fix the problem, then they have to replace the appliance. And that covers AC, hot water heaters, stoves, microwaves, refrigerators, dishwashers, and it can really be a lifesaver at times.
Gotcha, gotcha. So kind of transitioning then into credit preparation.
Credit preparation.
Yes. So say for those that don't have the best credit at the moment, they messed up during college and racked up debt, did whatever. How long should you wait before you consider looking into buying a home to give time for your credit score to reflect on the steps that you're taking to, bring it up?
Well, how is it going to, I guess the question is, how is it going to recover? If you have derogatory items on your credit, the best thing to do is to actually address those items. I recommend, doing it the right way as opposed to going to the quote unquote credit repair people, because some of them can be kind of predatory in nature.
Okay.
So I recommend a credit counseling agency.
Gotcha.
And there are some legitimate credit counseling agencies. They tend to be nonprofit. And those are the ones that I strongly recommend, but it's how you deal with the derogatory items on your credit. They're not going to just magically disappear, as a lot of people think. In most instances, they will disappear after 7 years, but they don't have to. And that's what I tell people. So it always comes down to, is this a legitimate debt or is it not? And if they say, yes, I do owe it, then I'll say, well, you need to address this. And a lot of times it might be something small that's stinging. So what I recommend is, number one, getting a copy of your credit report. You don't know what type of health you're in until you go see the doctor and they give you some type of report, usually your blood work and all of that kind of stuff. Well, kind of the same thing with a credit. If you don't know what's on your credit report, how can you fix it? And then the way to actually address those things is to maybe start with the smaller items, and I've seen people that literally had like $25, $50 credit collections. And I'm like, if you start fixing those, just pay them off. Some things aren't worth challenging, you know? And I've been in the role of an underwriter before in the mortgage industry. And of course, underwriters give the loan the thumbs up or the thumbs down. And I could almost tell instantly if someone went to a credit repair company, because if you go to a credit repair agency, a lot of times they just dispute everything. And I always ask them, well, what's the likelihood if you have 9 accounts on your credit report and all 9 are in dispute, you're basically saying they all made the exact same mistake about you. They made a mistake in saying you owed them money when you didn't. What's the likelihood of that happening? So if there's ever a gray area, and underwriters of course have to follow certain lending guidelines, but there is some leeway when they have some factors that may show you in a better light. Well, why would they stamp that loan approved when they see all of these disputes? Because in another 12 months, whatever loan they give you probably will be in dispute as well. So you really have to be careful about how you address things, because it kind of does speak to your character.
Okay. That makes
Make
perfect
sense?
sense. That makes perfect sense, especially, you really have to take care of those things because, like you said, they'll never go away, or your bad habits are hard to break. So they look at some of those habits and those spending habits along the way.
Right. And there's a lot of times people don't really realize what's on their credit report. Like, it never fails. And I pull credit reports several times every day. And there will be medical collections on there. And they were like, well, I had insurance. Well, a lot of times the medical stuff, some of it is legitimate, but some of them are basically billing errors. where you might have switched insurance companies. And I've had that happen where I switched insurance companies because I switched jobs or something. And the doctor might have had the old insurance and they billed them and then they declined it, of course. And then next thing you know, they got it on my credit report that, hey, you stiffed us for a bill. And so all you have to do is then say, oh no, I had this insurance, and provide them with that information and they'll charge the right one and they can get that off.
Perfect. Now, switching over to those that have good credit, what should those that have good credit avoid before looking into buying a home?
Um,
Obviously,
Closing out.
one
Well,
is
number one is because a lot of times people, and I've seen one of the critical mistakes that people make is that they will pay a bill off and they'll call a creditor up and they'll say, close the account. Well, chances are when you close the account, it's going to cause your credit score to drop because you're now closing off a good trade line. Like, for example, I've had a pennies account for 20 plus years. Okay. And I very seldom use it, but most of the time it's zero. Okay. If I call them up and say, close that account, then I'm closing off a 20-year history. So you don't want to do that.
Gotcha.
Also, you don't want to, so when you pay them off, it's okay to have a zero balance and just leave it and don't charge it. Another thing that I would recommend you do is probably clear up any little small items, those things that are little small things, especially if you're somewhat limited when it comes to income, because of course mortgages are risk-based products, and of course your debt to income ratio comes into play. So the lower the debt, generally the better financial health you're in.
okay. I mean, obviously, we know that the easy one is don't have a lot of things, a lot of people pulling your credit. And one of the things that I've heard too is you can have multiple lenders pull your credit as long as they're pulling for mortgage or home buying and not other things, and then it'll actually pull your credit one time. Now, how many days do you have? Is it what, 60 days?
Generally is a 30-day window.
30-day. Okay.
30-day window. Yes, absolutely. And that goes for if you're buying a home or if you're buying a car. A lot of times you may go into a car dealership and they'll sit you down with the finance people and they'll get your information, and unbeknownst to you, they're shopping you all over God's creation. Well, a lot of times they're shopping you kind of for the best rate for you and for them, kind of. So the credit bureaus will only ding you for the one pull as being a hard pull, and any subsequent pulls for an automobile loan will be considered a soft pull. Same thing goes with mortgages.
Okay.
So they kind of encourage you to shop. Because if you shop, you don't know you're getting a good deal or a bad deal unless you're shopping.
That's very true. A lot of times people go with their credit unions or wherever, but then they realize, what, somebody might be able to help me with my closing costs or something like that.
Right.
So
exactly.
Makes perfect sense. Now, what factors kind of come into play when you advise someone whether they should take a 15-year mortgage or 30-year mortgage? I know like payments is one of the things, that people should consider whether they can afford it or not, but what else?
Payments and their overall financial goals. I like for people to paint the picture for me. Like, for example, I'm somewhat of an older gentleman, and if I were to go out, and I can't discourage anybody from, who knows, I may want to buy a house in the future, but it would not be wise for me, unless cash flow was a consideration, to consider getting a 30-year note. I may want to consider a 15-year note. And so it just all fits into your financial goal. If you want to be, for example, and one of my long-term financial goals is to be 100% debt-free, especially heading into retirement age. Well, if that's one of your goals, why would you go out and get a 30-year note as opposed to getting a 10-year note or a 15-year note? Number one, the 10 or 15-year note is going to have a lower rate, because the shorter the term, the lower the rate, but the higher the payment. As long as your debt to income ratio can afford it and can sustain that payment, then you're okay. But it just really depends on your overall financial health. I would be leery of anybody who just automatically decided they wanted to put me into a 30-year note, because they don't know what my goals are. Don't make those assumptions.
Very true, very true. I think that's the hard part when it comes to that. Like you said, when you're considering it, you're like, you know what? I may not want to stay here long term. So maybe I do a 15 year, or maybe I do a 30 year, like you said, or kind of max it out.
Well, you got to think too, it is an investment tool. So even if you are paying a higher amount, what are you doing? You're actually building equity a lot faster. So it's your money. It's your money. No matter how you look at it, you're building more equity and you're building it at a faster rate on a 15 or a 10-year note as opposed to a 30.
Hey, listen, that makes perfect sense. And especially, so what about for those that are wanting to have multiple homes? They're not first time owners, but they want multiple. Do you
So they're
advise?
an investor. Basically, that sounds like you're talking about an investor. Well,
Mhm.
usually with investors, it is more of a cash flow thing. And in that sense, I would probably do a 30-year note if I'm doing it as an investor. But
Okay.
here again, I'm not going to make that assumption. I'm going to ask that as an experienced loan officer, I'm going to ask that question. Okay, so this is an investment property for you. What's your goal? When do you want to have this paid off? Or is it your goal to have it paid off? Because sometimes it's just a cash flow. It's strictly cash flow. They're using it for the income, and that's a good thing as well.
No, that's perfect. No, that's awesome. And one of the things you've taught me, and I've sat in some of your workshops as well, is when it comes to budgeting, right? For a new home, you obviously should budget for your monthly payments and your closing costs and things of that nature. And there's a long list of things that come up in the closing costs.
Right.
Well, should people consider factoring in an emergency fund as well, like just in case things come up?
Absolutely. And a lot of mortgages are a lot of, especially your government loans, they are kind of sensitive, and we also have some construction products that are a little sensitive to your reserves, the amount of money you have after you get up from the closing table. Because let's face it, if you get up from the closing table and you're flat broke, the chances of your going into foreclosure are greater than someone who goes into the closing table and after they get up from the table, they have assets in the bank, liquid assets or a 401k with a couple $100,000 in it. What's the likelihood of them letting a house go into foreclosure when they have liquid assets? So here again, mortgages are still risk-based products, and it's going to be reflected throughout the process.
That makes perfect sense. I think that's the hardest part is like, well, what happens? I think some people think, especially with like flood insurance and things of that nature here in Jacksonville, especially, like, should I prep for that, or should I prep for any of those things that insurance may not cover? Because
Well,
that's a surprise to people. They're like,
with
wait,
flood insurance, for sure, that's going to be a requirement if you're in an area where that area, like for example, if you found the perfect home and you decide, okay, this is the house that I want, and you do a contract on it. Well, once that loan gets into process and it gets behind the curtain and they're processing your loan request, the first thing they're going to do is do a flood certification, for example. And they're going to know based on that address and that specific parcel of land that if it's prone to flooding or rising water, then you're going to be mandated to have flood insurance by FEMA.
Okay.
FEMA is going to determine that.
Okay, gotcha.
But yeah, you definitely need to take into consideration, because what's going to be included in your debt to income ratio is anything that's currently on your credit report, plus your principal, your interest, your taxes, your insurance, any flood, and also homeowners associations. All of that is included in your debt to income ratio.
Okay.
Because you have to pay it. And if you fail to pay, for example, if you fail to meet any of the rules and regulations of the homeowners association or the condo association, they can foreclose on your house even if you're making all payments to the lender on time.
Wow.
Yes, they can foreclose.
Okay, well,
that's why it pays to know what's in those governing bylaws and rules and regulations of any homeowners association or condo association.
That makes perfect sense. I mean, you talk about that, your principal, interest, taxes, and insurance, right? All a part of the payment.
Right.
Now, I think one of the things you mentioned before was things about escrow accounts in which taxes and insurance can go into the escrow account. Then they use some of that to pay
Right.
off those years. Tell us a little bit more about that. I mean, is it a plus or is it a minus? Is it more?
Okay, well, it's a necessary thing in most instances. Okay, so for example, and there are going to be a lot of acronyms in the mortgage industry. Well, PITI, I think everybody kind of knows, but if they don't, I'll go ahead and explain it real quick. Principal is the amount of money that's being borrowed. Okay, what the bank is going to do, if you got $100,000 loan, they're going to take $100,000 and they're going to divide it up by the term. If it's a 30-year note, then they're going to divide it by 360 months, and that's going to be the principal portion of your payment. Interest, of course, is the cost of borrowing money. It's the cost of using anybody else's money. Okay, taxes are the property taxes, and insurance is homeowners insurance. Okay, now the taxes and insurance are paid once annually. They're not paid every month, but every time you make your mortgage payment, you're paying a little bit into the lender to cover it, so that when the tax bill comes due from the city of Jacksonville or wherever you're from, they will have the ability to take the money out of that account and pay that tax bill for you. Same thing goes with your insurance. You're free to choose whoever you want to cover your home. It could be State Farm, Allstate, Progressive, whoever. It doesn't matter to us, as long as you have a policy in place. And what we will do is, if that insurance company says, hey, it's going to cost you $1,200 to cover this house for the year, we're going to take that $1,200 divided by 12 months, $100 a month is going into that escrow account, so that when that bill comes due, there'll be enough to pay it.
That makes perfect sense. I think a lot of people look at escrow and they're like, what?
Well, oh yeah, one important thing. Okay, so escrow accounts are mandatory on FHA loans.
Okay.
And I believe on VA loans as well. You can get by on a conventional, and now we're getting into the loan products. Okay, so you have government loans, which are the FHA loans. Okay, federal housing. VA is for veterans, and then you also have one other little known or rarely used government loan, which is USDA, United States Department of Agriculture.
Okay.
Okay, so if you're out in rural America and you decide, hey, you're in a place where you might see chickens down the road or horses down the road, then chances are you're going to be in a USDA eligible area, and they will allow you to buy it as long as it's not a commercial farm or anything. Okay, as long as it's not, and those are beautiful loans, they're 100% financing on those. Okay. Now, you also have some conforming loans, which are generally Fannie Mae and Freddie Mac loans. Generally speaking, those loans are more credit score driven. So if you have good credit, chances are Fannie and Freddie is the way to go, because number one, another acronym that you're going to hear in this business is LTV, loan to value. So if the bank is loaning you 80% or more, if the house is $100,000 and you're requesting a loan of 80,000 or more, you're going to be mandated that you have to have escrow accounts. Why? Because if you have escrow accounts, the chances of foreclosure here again are reduced, as opposed to somebody paying their own lump sums at different times in the year. So if you have, most people don't get conventional loan products until their subsequent home, when they have equity from the house that they're selling and buying a new home, then they have maybe the 20% to put down. Then you would not want an FHA loan. You would more or less be appropriate for a conventional loan. And there are some other conventional loan products that will go up to 90 and 100%. So, it just depends on the lender.
So even after what happened, people would still consider the Freddie and Fannie?
Oh yeah, absolutely. They're great loans.
I mean, I know that's terrible for me to ask, but.
Yeah, no, they're great loans. I've done them. Yeah, they're great loans. I mean, because here again, they're more geared towards people, they're more credit score driven, meaning the better credit, the better the rate. Whereas FHA is designed to help people, first time home buyers get in. They have a low rate. However, The one difference with FHA loans and also with conforming loans, Fannie and Freddie, where you're over the 80%, not only do you have the escrow accounts, but you also have what is known as private mortgage insurance,
Okay. The
PMI.
PMI.
PMI is, it does absolutely nothing for you as the consumer. It doesn't protect you. It protects the lender against your defaulting.
And that's something is that something they recently put into place, I presume?
No, it's been in there for a long time. The
Okay.
thing is with FHA, it's PMI is for the life of the loan. There's no getting rid of it unless you get out of the FHA loan and refinance into a conforming loan. Now with conforming loans or Fannie and Freddie, you're going to have PMI as long as the LTV is over 80%. Once you reach under 80%, then you could petition the lender with a legitimate appraisal to show that you have at least 80%, 20% or more in equity in the property, and they would have to remove the PMI.
Okay.
And on the first time home, average home price, you're probably going to be paying about 140 to 150 a month for this PMI.
Gotcha.
And that's factored into your debt to income ratio as well.
Gotcha. No, that makes a lot of sense. I mean, thinking about all that stuff. So being that you've done this a long while and you have
Right.
a home and, there's so many of these things, you've seen people make mistakes, you've made mistakes yourself. Tell us a little bit about mistakes that you've made and lessons learned and what you've experienced that you can share.
About
Just the process or in general or.
Well, the one thing that I've not experienced it personally. I haven't really made too many critical mistakes when it came to that, but I have seen people refinance for some crazy reasons to pull cash out of their house, to pay off unsecured debt. So now you're kind of tacking on, like, let's say a person who's out of control spending and they have crazy credit card debt, to the tune of 40, 50, 60,000 or more. And I've seen it where they will refinance, pull the cash out of their home, pay off the debt. Well, it all sounds well and good, but you still have this open trade line, even though you paid off this Visa or Capital One or American Express or Discover. Even though you paid it off, it's still now open and you can recharge it. And I've seen people do that. So it's like, if you're not in control of your spending, it makes no sense to refinance,
Right.
pull money out of your house to pay off debt that you may owe just to recreate more debt. That just doesn't make sense.
Just do all that just for nothing.
Now, I've seen people who have done it, but they're more strategic in their, like, for example, they may own their house out free and clear, or they paid their house out and they still like the idea of having a mortgage because of the tax advantages. So they may do what we call a home equity line of credit, which is a HELOC. It's called HELOC. That's another acronym, but it stands for home equity line of credit. And they just buy stuff on the HELOC and pay it off because it is a mortgage product. And keep in mind, it's sort of like a credit card and it's revolving where you could pull money and pay it back and pull money and pay it back. So you can, I've known people that literally have bought cars on it because the interest and stuff that you pay on a car is not tax deductible, but the interest that you pay on on a home is. So they're putting it under a mortgage product to get the tax advantages. It's all very, like I said, those are savvy people and they obviously have the assets a lot of times to pay the debt off at any given time, but they're choosing to do it through a mortgage product because of the tax advantages.
That's interesting to know. I'm like writing that down, like, wait a minute, there's going to be a time where I'm going to want to do something like that.
Yeah. Well, realistically, if you've been paying on that house for a while, I've been in my house 20 years. I'm sure I got a ton of equity, because I'm on the tail end. Right. And, if I actually am in a tax bracket to where I need some tax shelters or tax advantages, then yeah, I need to start considering that kind of stuff.
Right, right. So that's talking about some of the mistakes and lessons learned and like also advice on HELOC and such. What are one or two things that you are glad you did or helped somebody else do when they went through the process of purchasing a home that you can share?
Just, I, just put them in a better financial situation. I just say that. I mean, home ownership is not for everybody. I'll be the first to say that, and that's not necessarily the best thing for a mortgage professional to say. But for some people, if you don't have that budgeting thing down pat, you really need to really consider um, whether home ownership is for you until you can rein it in, because um, having a foreclosure on your credit report is just as weighty an item as a bankruptcy.
Mm,
It weighs pretty much the same, maybe worse.
ouch.
Right, right. So you really have to really be very careful with, and I like to have those conversations, especially with people who, if I see some derogatory things like repossessions and stuff like that, yeah, you might be able to navigate around some of that stuff with certain types of loan products. However, that the reality is you owed somebody that you did not pay. If you do that with a mortgage, that's going to hurt you significantly. It's not like walking out or breaking a lease or getting a car repoed. It's going to be drastically different.
Yeah,
Very weighty, a very weighty item on a credit report.
that's definitely something for people to consider. And I think that also flows into first-time home buyers. What is some advice that you can have for them? Somebody that's never been through the process and watched other people, they always say it's different when you go through the process versus watching somebody else.
Well, the very first thing is a lot of times people feel like, well, I can get a good deal on a fixer upper. Well, for a first time home buyer, I would caution against that. I would let them know that probably you want a house that's in pretty good condition. And if, for example, you're needing any kind of down payment assistance to get into a house, I would strongly recommend it at that point, because number one, you're probably low to moderate income. And where's this money going to come from? If you've got to put an AC unit in, that's going to probably cost you anywhere from $6,000 to $8,000. A roof on, that's going to cost you anywhere from 10 to 15,000. So, and then not to mention, some of your down payment assistance programs have pretty serious home inspection processes, and they're going to pretty much require that the house be in generally good repair. If you're talking cosmetic, I'm okay. But if you're talking structural stuff, I'd say, fixer-upper is not necessarily for you.
That makes perfect sense. Now, there are going to be people that say, you know what? I have the income, I have the down payment, I have everything else that I need, but as far as knowing that I'm gonna have to pay for things when they break, I'm gonna have to go through all this maintenance, all this landscaping. I don't know if I want to do all that. What advice would you have for them to overcome that fear?
Well, warranties, the home warranty that I mentioned that I have, and I'd be more than happy to share. I don't want to advertise anybody, but there are a lot of different home warranties. I have one on a rental property, and I also have one on my primary to help, limit my exposure. It's sort of like an insurance policy. So I know that if anything goes wrong with this house, if the AC blows out, as long as it's not due to negligence and I've been maintaining the unit, getting regular service calls, that, I'm going to be limited in terms of how much I'm going to my deductible, $100 and I'm good. So that's the main thing. And just your lifestyle, again, it depends on what your lifestyle is really like. You may want to consider a condo or a townhouse, because that's going to require a little less work than a single family house.
That makes perfect sense. I mean, I want to dive so much deeper into so many other things because I've actually sat through
Oh,
your presentation and I'm
oh,
like,
it's a
there's
lot.
so much more to talk about. I mean, just based on just a starting point, is there anything else that you'd like to share?
Well, the very first thing you need to do, I would say, is if you feel like, well, generally speaking, I have pretty decent credit, and I got money saved. Of course, you never have enough. I tell people, even when you think you have enough saved, keep saving, because you never know what kind of unexpected expenses might come with buying a home. But I would say, get a wellness check, so to speak. And like I said, there are some housing agencies, and I'd be more than happy to give you that information, to share that information with you, of a legitimate, very reputable company that does financial and credit and housing counseling. And that's for people who feel like I might need to tweak a few things. If you don't, then basically I would say start looking around. You might even want to do your searches online in terms of Zillow to kind of figure out what are some of the things that you're going to want and what are the price points, because I think a lot of times people have an unrealistic expectation of how much house they can afford. And generally speaking, it's because we go off of net income. I mean, when I say we, I'm talking about consumers. Consumers go on net income. What's hitting my direct deposit? That's what I have to deal with. Well, banks don't look at it like that. Banks look at gross income. Your gross income could be vastly different than your net income. And generally speaking, they're going to look at about 45% of your gross income in terms of the most debt you will be allowed to get in, including your new house payment and including everything that's hitting your credit report. So you need to kind of, I would say, get a feel for how much house you think you can afford, because everybody has a different debt tolerance level. Figure that out. Look at some of the things that are accepted. You're not going to get everything you want on your first house. I promise you that. But if you stay in it a number of years, that could be your perfect rental property. So you got to look at some of the must-have items and some of the things that you could not necessarily have right away, but know that it's not forever. This is an investment tool, just like anything else. A house is an investment tool. So kind of figure it out, put a plan together, and if you feel like you're ready, then you want to go through the pre-approval process. But you don't need to go to the pre-approval process too early. I would say probably within 90 days or so, maybe 120 days. That's when you want to start intensifying your efforts. You might want to contact a mortgage professional such as myself or whoever else you might be inclined to use, and ask them to do a pre-approval on you. And they're going to look at your income. They're going to look at your assets. They're going to look at your credit and say, well, based on these factors, this is how much house you can afford. But now keep in mind, most people qualify for more house than they're willing to pay for.
Mm.
It's a fact.
So how long is that pre-approval going to be good for?
Pre-approval is good for your credit report is good for 90 days, generally. Okay, but I'm saying you want to start looking probably, like for example, if I know I'm in a lease until next June, it's no needing me getting pre-approved right now. Okay, if you're June, then you want to start maybe February, March to kind of give yourself time to find something. But you're going to need, no realtor is going to show you a house without a pre-approval letter, because you got too many people out here that would waste their time,
Right.
and haven't gone anywhere, and just this is a seller's market. They're going to demand that you have a pre-approval letter.
I was gonna say it definitely is a seller's market right now. I would.
Oh yeah, yeah. People are paying. Some people are paying more. Are paying more than what a house is appraising for.
Definitely.
There are people willing to do that.
And you may mention a great website, which is Zillow. Is there any other website somebody could go on to help with understanding what their debt to income is and things of that nature? Or it's just like you
Not
Google
not
it?
debt to income ratio, but just to do a search for houses. Realtor.com is another one. I think between them and Zillow, that's kind of what I've used in the past, just to kind of do a brief lookup. Or you may have somebody who's considering refinancing as opposed to purchasing, and they want to think about, well, how much is my house worth? But be very leery about how much information you put online, because as soon as you fill out certain things and put your information in, of course your phone is going to start ringing off the hook, and you're going to get all kind of emails and that sort of thing. So just be careful.
All those blasts.
Oh yeah,
They want for sure.
just from one inquiry.
Oh my gosh, trust me, I went through it and I was like, how do
Yeah.
I subscribe?
Yeah, you could go on sites, what is it, Lending Tree or some of these other ones where it asks you to put in your information, and next thing you know, you got offers coming from everybody.
Oh gosh, no.
Yeah.
No, I think that really helps too. I mean, this all ties into your last topic of building wealth. If you do it the right way, and the biggest advice is get with people that have been where you are going. That is one thing I live by so much. So people that have homes, people that
Right.
have many homes, go out and ask them some advice. If they're obviously, for those that are close, they're going to be willing to teach you, willing to say things. There's so many things out there for you. And like you said, the credit health is important.
Right.
If you need a credit counselor, get a credit counselor to help you through what you need. That's
Right.
the very first step in understanding your budgeting aspect. To your your other point is, if you're not in the budget and you're not in the place to purchase a home, don't just purchase a home to keep up with the Jones. That's going to
Right.
put you in a really bad spot.
Right.
And you're not going, and it's scary to know that all of that is much worse than repossessions. Having a foreclosure on a home, much worse. That's something to really, really consider as well in all of this. And I think at the end of the day, if you are a good budgeter, and you practice with that first and say, what can I afford? And not to say that you want to, they always say you spend and you kind of spend less than what you want, because they're going to give you a pre-approval paper and say, here you go.
Right.
Don't try to go for that and just be like, oh my goodness, this is amazing. You're going to put yourself in a bad spot.
Right. Let them know what your budget is. I would never let anybody just tell me the maximum amount I qualify for, especially if I don't want to buy that much. Now, and for those people who might say, well, I think I'm willing to pay $1,500 a month for a mortgage, because if it's mine, I'm willing to pay a little extra. Okay. Well, if you're willing to pay a little extra, and right now your rent is $1,100, then what I need for you to do, listen up, is put that $400 in a savings account and keep it there without touching it. That way you're making the $1,400 or $1,500 payment, and you need to know what that feels like. You know what I mean? Start making the payment, even though you're only paying $1,100 to your rent office, but that extra put it away. If you say you can afford a $1,500 payment, put that away. Make that $1,500 real to you and see how it feels.
Yeah, that's going to be a big one for sure. And I think, I don't know, unfortunately, things aren't the way that they used to be, where you're not going to get a home that's bigger and cheaper from what you did, years ago. Luckily, if you're living in Florida area where we are, you're not going to be paying California prices, but you're still not going to be paying what we paid before. Do you think, just out of curiosity, do you think we'll ever get back to where we were, where you can get something for cheaper? No.
That boat has sailed. And everybody still thinks that for those who are sitting on the fence thinking that the market is going to correct and that the bottom is going to come out, keep in mind that Florida is red hot. It may, but for that to happen, it would have to be a total devastation to our economy, because everybody is trying to get into Florida right now. You got people that I'm feeling calls from New York, Colorado, all of these different places that have just gone crazy with the prices. and they're selling out in places like Connecticut and New York, and they may be selling a house up there for $700,000-800,000, and in that same house, that same money would buy you a mansion in Florida. You could spend probably half of that and get a nicer house than what you're leaving up there. And of course, we're in a virtual environment. Why not live in Florida as opposed to having to shovel snow? So it's really crazy right now. And that's why people are willing to pay coming into this market, and in just about every other Florida market, sometimes $20,000, $30,000 more than the appraised value.
Whew.
Right. Because they know it's coming. But likewise, I've had people who have started new constructions, because right now, depending on what kind of construction you're getting, but it's going to probably take you at least a year or better for a brand new construction. Well, some of the construction prices when they started might have been at 280, and those same houses are appraising at now 340. So they're getting equity day one moving in. So here again, now the builders are starting to play hardball, because they know that if you don't buy it, I'll just flip it over to somebody who's going to pay more now.
And that's exactly what I was going to ask about. So from a builder standpoint, I don't know how much you're into the different builders like KB Homes and Miranda and all of those other different builders here. Do you feel as though the quality of the homes are going down because they're building so fast?
Well, I would hate to think that the quality is going down, because number one, with the new constructions and having been through that process a time or two, you get inspections out the ears. They do this little stage in the construction phase, and they have to have an inspector come out, and like plumbing and electrical and everything. So you do have some safeguards in place to make sure that the work is being done in a quality manner.
Okay.
So I think the quality is pretty much there. The thing is that the cost of the materials, the concrete, the lumber, everything is just gone through the roof. And
Right.
just getting for example, I'm one of the preferred lenders for Habijacks here locally, and those houses are starting to really appraise kind of high. I mean, you're talking about houses that might have appraised at like $90,000, $100,000 just a few years ago, are now going for 140,000, 150,000, and that's in Duval. Some other places like St. John's, they might be 200,000, and these are affordable houses. So the days of you're getting into a house for probably little or nothing, and those days are. I don't see houses under 100,000 anymore.
Wow.
I don't know the last time I seen one.
Right.
That costs under 100,000.
Right. That's good quality too, that aren't fixer uppers.
And usually, if you do see $100,000 house, that's an investor.
Yes.
They're going to snatch those up, and chances are the reason I could not be seeing them is because they're going cash and they don't need a mortgage.
Very true. Very true.
Yeah.
And that was the biggest thing is, as I got everything of that nature, I started to realize, hey, everyone's trying to do this, man. Everyone's trying to do this fixer upper, and they're trying to do like Joanne and HGTV and do all of
right.
It
Right.
It's a good thing to do. You just have to make the time or get you a property manager to help.
Right. Absolutely. Yeah.
Wow. Oh man.
But I can honestly say, and this is for also for somebody who might be in the search for a house, I would say, in addition to a mortgage professional, you really have to pick a realtor that is working on your behalf, and one that you really have a good relationship with, because they're going to be worth their weight in gold to you. They are going to be responsible for writing up the contract. And even if you are looking and inclined to go into you mentioned construction, but you mentioned going into like KB and places like that. Well, those tend to be tract builders. They're in a particular neighborhood, and you go into their subdivision, and they want to kind of manipulate every little bit of the transaction in terms of writing up the contract and everything. Well, keep in mind, when you go into one of those communities and you sit down with a professional in there, they're representing the builder. You need to have your own person to go in there with you to write the contract that's going to be in terms that are going to be favorable to you and them.
Gotcha.
Okay, so you have to really watch some of these new constructions, and if you happen to just go in there without your realtor, a lot of times they're gonna ice them out. They're not gonna allow them in to be a part of the transaction because you went there without them.
So they're
So
like,
you
well, we might as well
be very careful. If you see a community that you're interested in, call your realtor and have your realtor set up a time where you could go out and see the model houses. Because if you show up there by yourself and they handle everything, then you're going to be subjected to whatever they're doing.
Right, because obviously they'll just slip a lot of things through the cracks and say,
Right.
well,
Right. Well, and then not only that, they purely are representing the seller, which is the builder.
yes.
You know, so some of the terms may be kind of slanted in their favor. You know,
That's good advice to know.
and not only that, they'll try to tell you, well, if you don't go through our people, we won't, pay any closing costs. We'll pay. Of course, you're going to pay your closing costs regardless,
Right.
but they're going to tell you, if you don't use our people, they want to manipulate the entire transaction. Well, what you have to ask yourself is, why are they going through these lengths to control every aspect of the transaction? Because they want to control every aspect of the transaction. And they want things in there, they want things that are favorable to them.
Yes.
So you have to be very, very careful.
Gotcha. I think that's why a lot of people go through a realtor, but they also don't want, some people are very leery about doing that because they don't want to pay all that extra cost or do any of those, things.
Well, you don't pay the realtor. That's the good thing. The sellers always paid the realtor. And the bottom line is it's incorporated into the price of the house. If you go in there and you're talking to a realtor that's sitting at the desk and they're writing up the contract, they are a realtor. They're just being paid by the builder, and the builder is probably getting them at a reduced cost, but you're still all of the fees associated with selling a house are incorporated in the sales price. You could better believe.
Right, and that's what I mean, sorry, is they think that being incorporated in the sales price, you're paying extra.
No, you're not paying extra. No, you're not paying extra. It's already built in. It's baked in the cake.
Gotcha. Yeah, that's the misnomer that a lot of people go by, is I don't want to go with realtor because of that extra.
Right.
Like, I'd rather do it myself.
Right. And the same thing happens when you go riding through a neighborhood. You may see a nice a nice house, and it's got a for sale sign out there with a realtor's name and number on it. I recommend you not call them. I recommend you call your realtor and have your realtor to contact that realtor on that sign, because here again, that realtor sign, they represent the seller, period. Period. Whereas your realtor you might tell them, hey, I need the seller to help out on my closing costs. I need them to pay 2%, 3%. And even in a seller's market, I'm still seeing contracts with sellers helping out.
Oh, wow.
Wow. Right. It all depends on the realtor. And some realtors just never ask. Some realtors will never ask. They get so excited about the sale. Oh, you found something you like. They stroke the pen for the sales price, and they never think to say, well, let's ask for it. All they can say is yes or no, but they're assuming because we're in a seller's market, the seller's not going to do it. Well, I don't need you to make those assumptions. I need you to make the ask.
Yes.
And,
like the first they can do is say no.
Right. Depends on how many days it's been listed. If it's been listed for a while, there's a reason why it's listed for a while. Either it's too much or something, or if it's new on the market, they may not have had a whole lot of feels yet. They might be willing to do that and say, okay, we need to do something quick.
Yes, and we'll need to pay this.
Great.
Oh, I didn't even think about that. Well, thinking about, oh my God, I gotta shop around to see who actually pays the most of these closing costs. That's a simple thing to ask.
Some realtors are very skilled at it. I will just say that. Some realtors, I got a couple realtors, I've never laid eyes on them, but it never fails. I see contracts that come across my desk with their name on it, and they don't ask me how they're doing it, but they're able to get the seller to concede 2%, 3% of the sales price So $100,000, $3,000, $200,000, $6,000. It goes on and on, yeah. And it's great.
That is amazing to know. I think that this is definitely helpful for those that, like I said, we did a little mix of, majority of it is first-time home buyers for those that are fearful of it, but then also consider doing things like this for investment properties, but also be mindful and careful that it's all for, like you said, your lifestyle, your age, where you want to go, where you want to grow, if you're closer to retirement, all of these things.
Financial goals. Yeah, my financial goal might, and it could be young. Like even where you are, you might say, well, I don't want to pay for anything more than, I want my house paid off in 10, 15 years. That's fine if that's in your financial goal, because what's happening is, as long as it's within your debt to income ratio, you're building equity. It's just like you taking money and putting it into an account. You're building equity.
Right. Oh man, Moses, I appreciate you so much. I selfishly am going to take some of this advice.
Well, that's fine.
Yeah.
And for your audience, Rochelle, feel free to share my information. I know we talked about a couple of things. Credit counseling, if you need that information, I can give you that to put in your whatever links or what have you. I don't know how that works, but I'm not all that tech savvy. But if you need that, I'm here and I'm available at any time to answer any questions that they may have after this, because it's a lot of information. It really is.
It is.
And the housing counseling agency that I recommend also, they actually have, and they were founded by the United Way, so they are a nonprofit. They have an 8-hour homebuyer education class, and you're talking about so much information, but it never fails. And I used to teach those classes, and I still do occasionally, but it never fails that people were coming in those classes because if you wanted down payment assistance, for example, from the state of Florida, like Florida Bond or the city of Jacksonville had a Head Start to Home Ownership program where they were offering like $12,500 for down payment assistance. Well, one of the requirements is that you go to a housing counseling agency for this 8-hour class. Well, the agency I'm talking about is on everybody's list. So I would recommend maybe even sitting in that class, getting as much information, but I usually ran into people that was like, wow, I wish I would have did this a lot sooner in the process, instead of just knowing that I need to take this class for this money that I'm trying to get, instead of saying, well, had I gotten into this class a lot sooner, I would have navigated around a lot of craziness.
Right. And taking that in consideration. Yeah, definitely. I'll post the link of your information, since you've given the permission to share it, for sure. If anyone has any questions or just wants to reach out, you've given the permission.
Yes.
Wow.
Absolutely.
Any last words?
No, none. That's it. I mean, you've asked some really tough questions, but that's good though. That's great.
Yes, hey, that's what I'm here for. No, I appreciate you so much for coming back on to Aspire to talk about the home buying process. Again, this is an amazing person. As you guys can see, this is someone I go to for a lot of financial advice, Mr. Moses Henry. So I appreciate you all so much for tuning in to today's episode, and we'll see you next time.
See ya. Thank you. Bye.